$42,611. That is the exact amount of money I did not make because I waited just 2 years too long to start. And in this video, I'm going to show you the actual final balance, down to the cent, of what consistently investing $500 a month for 7 years produces. Not a projection, not a hypothetical. The real math, the real mistakes, and the one number most finance channels never show you. 7 years ago, I made a decision that felt completely unremarkable at the time. I set up an automatic transfer, $500 every single month, into a brokerage account. No stock picking, no crypto, no options trading. Just a boring systematic investment into a broad index fund. I didn't tell anyone. I didn't make a video about it. I just let it run. And here's what happened during those 7 years. The market crashed twice. Interest rates spiked to levels not seen in decades. Inflation hit 9%. Everyone I knew was either panic selling or convinced the whole system was broken. I kept transferring the $500. Let's establish the baseline first, because this is where most people underestimate what's actually happening. $500 a month, that's $6,000 a year. Over 7 years, that's $42,000 of your actual out-of-pocket money. Now here's the question that determines everything. What happened to the rest? Because when this experiment ended, the account didn't have $42,000 in it. It had significantly more. And understanding why, mechanically, mathematically, is the difference between someone who builds wealth and someone who earns a decent income their whole life and ends up with almost nothing to show for it. Here's what compound interest actually looks like in practice. Notice something. The first 3 years look almost flat. You're putting in real money and the curve is barely moving. This is the phase where 80% of people quit. Let me walk you through every single year, because the story isn't in the final number. It's in what you have to survive to get there. Year 1, total contributed, $6,000. End of year balance, approximately $6,400. The market returned around 7% that year. You made $400 in gains on top of your contributions. Nothing exciting. But nothing was supposed to be exciting yet. Year 2, total contributed $12,000, end-of-year balance, approximately $13,000. You've now made $1,500 that you didn't earn with your labor. The curve is still flat. Most people at this point feel like this isn't working. Year 3, total contributed $18,000, and then March 2020 happened. The account didn't have $21,000 in it anymore. It had roughly $14,800. On paper, you'd lost more than a year's worth of contributions in 5 weeks. Year 4, total contributed $24,000. The market recovered. End of year balance, approximately $34,200. You contributed $6,000 that year. The account grew by nearly $20,000. You did nothing. That is the mechanism working. Year 5, total contributed $30,000. Another crash, the account pulls back to roughly $36,000 despite contributions. The transfer went through again. Year 6, total contributed $36,000, end of year balance, approximately $51,000. You are now making more from market returns in a single year than most people make from their job in the same period. Year 7, total contributed $42,000. End of year balance, $68,412. The number I just showed you assumes a standard taxable brokerage account. Here's what happens when the same $500 per month goes into a Roth IRA instead. The contributions are the same, the returns are the same, but every single dollar of that, $26,412 in gains, tax-free, completely, legally, permanently tax-free on withdrawal. In a taxable account, depending on your bracket, you'd owe somewhere between $3,900 and $6,300 in capital gains tax on those earnings. Same behavior, wildly different outcome, just from where you put the money. And this is why the account type decision matters more than almost anything else in personal finance. But it's not even the biggest variable. That one comes next. The biggest variable, the one that separates the $68,000 outcome from a $200,000 plus outcome over a full career, is the start date. Remember the $42,611 I mentioned in the very first second of this video? That's the exact amount person B, the one who waited 10 years, will never recover. Not because they invested less time, because they missed the compounding window. The math doesn't care about your reasons for waiting. It only counts the years. Now I want to be honest about the 3 mistakes I made during those 7 years. Because this isn't a highlight reel. Mistake number 1. I checked the account too often in year 1. Checking a $6,000 account every day is psychologically brutal. The daily swings of $100 to $200 feel enormous when you can see them. I set the automatic investment and eventually forced myself to check quarterly only. That one habit change made everything easier. Mistake number 2. I paused contributions for 6 weeks in March 2020. I got scared. I'm not going to pretend otherwise. I paused the auto transfer for 6 weeks during the crash and restarted it when the market had already recovered 11%. I calculated the cost of that pause. It was approximately $1,800 in missed low-price purchases. The lesson wasn't be fearless. It was automate so your fear can't reach it. Mistake number 3. I didn't increase the amount as my income grew. If I'd increased contributions by just $50 per month each year, still a very modest amount, the final balance would have been closer to $84,000. That's $16,000 left on the table. In the final segment, I'm going to give you the exact 3-step setup I wish I'd used from day 1, because it solves all 3 of these mistakes automatically. Here's the exact setup. 3 steps. Takes about 45 minutes to implement once. Then you don't touch it. Step 1. Open the right account. If your income is below the Roth IRA limit, currently $161,000 for single filers, open a Roth IRA, Fidelity, Vanguard, or Schwab. All 3 have no account minimums and 0 fees on index funds. If you're over the income limit, open a standard brokerage and look into the backdoor Roth strategy, a topic for another video. Step 2. Buy one fund. VTI, FXAIX, SWTSX. Pick one. They all track the total U.S. stock market or the S&P 500 and charge you almost nothing to do it. Expense ratios under 0.05%. Do not build a complex portfolio. You do not need to. The evidence is overwhelming that complexity doesn't improve outcomes for long-term investors. It just gives you more decisions to get wrong. Step 3. Automate and escalate. Set the auto investment on the 1st of every month. Set a calendar reminder every January 1st to increase the amount by $25 to $50. That's it. That's the whole system. Your only job after this is to not cancel it when the market drops. And if you want a shortcut for that last part, I'll leave you with one reframe that's kept more people invested through crashes than almost any other piece of advice. When the market drops, most people see their account balance going down. What's actually happening is the price of your future shares is going on sale. Your auto transfer is buying more ownership of the global economy at a discount. A crash isn't a threat to your plan. A crash is your plan working correctly under pressure. $68,000. Built in the background. Through 2 crashes, a pandemic, a rate hiking cycle, and every news headline telling you to do something different. The machine doesn't require confidence. It doesn't require perfect timing. It requires one decision, made once, and the discipline to leave it alone. If this gave you one thing to actually do this week, not think about, do, drop it in the comments. I read every single one. And if you want the video that walks through what to do once your account hits $50,000, the strategy actually changes at that point. It's linked right there. See you in that one.